Hey folks, this is Mike Zlatnik, Big Mike, and today we're going to chat a little bit about a refresher on the investment quadrants and then adjusting for the risk of the COVID-created cost inflation world that we're living in today. Appreciate your time in advance. A wonderful disclaimer. Just a couple of words about our team. I'm going to be very brief, keep moving forward. Why people invest with us, I'll also keep moving forward. Okay, let's go back to the investment quadrants. So this concept I developed a number of years back, and the concept is extremely powerful. So let me just refresh you on the primary concept. So in our investment methodology, there are investment quadrants, and we use terms investment grade and speculative grade. By the way, just to be very clear, this presentation is purely for informational educational purposes. We don't give investment advice, nor are we soliciting anything to sell. So investment grade term is what we use for our purposes. And speculative grade is something that has higher degree of risk. So again, quadrant one is investment grade, which means safer. The terms we use here is investment grade, speculative grade. In the Wall Street, folks are used to the words conservative, moderate, aggressive. So investment grade is more conservative investments, some of them moderate, and speculative grade and general aggressive investments, some of them could be moderate. So why is it important is because thinking about the project you're investing in, it's always good to have a perspective. Are you taking extra risk or are you taking extra safety? And are you getting compensated to take extra risk? And how much risk are you taking? So again, quadrant one is cash flow quadrants. So quadrant 1 and 3 are the quadrants where you invest for cash flow, and quadrant 2 and 4 are the quadrants you invest for growth. So quadrant 1 is your cash flow investment grade quadrants. It's the safest quadrant. You have pretty good downside protection, typically low and moderate risk. And the deals that fall into this quadrants typically senior lien performing notes and conservatively leveraged equity investments in some multifamily or storage and so on and so forth. The quadrant 2 deals typically have no cash flow. They still have good downside protection. You're taking low to moderate risk. And what falls into this quadrant, some of the non-performing notes, moderately leveraged value-add projects. So typically the deals that don't fall into negative cash flow situations. Quadrant 3 typically covers strong cash flow but high degree of risk. So junior lien notes, mezzanine debt could be in this quadrant. Highly leveraged syndications could fall into this quadrant. There are a number of other deals that fall into quadrant 3. And then quadrant 4 is no cash flow, growth type of deals. And typically these deals are speculative in nature. So what falls into quadrant 4? Your development, your redevelopment, your land speculation, and heavy value-add projects. This is the foundation just wanted to cover so that we are going to jump into some of the COVID-specific risks and how to adjust for them. This slide just shows that the target returns in different quadrants are different. And they have to be, because if you are investing in quadrant 1, you're taking less level of risk and you're getting cash today, your target compensation or your target return is lower. The numbers we're using here are ranges, approximate numbers. They change for market conditions, depending on the type of a fund or type of a deal. So don't take these numbers for granted. This is just an example. So quadrant 1 deals could generate 10 to 15% target. For example, quadrant 2 has no cash flow, approximately the same level of risk as quadrant 1. So the return target has to be higher because you're not getting compensated in the form of current cash flow. If you're moving to quadrant 3, you're taking substantially higher level of risk, and you better have a higher degree of return. Otherwise, why take the risk? And then the quadrant 4 is the high risk and growth quadrant. You're sacrificing the cash flow, you're taking most risk. So you need to adjust for the risk, and you need to receive higher target compensation. Otherwise, why take the risk? This is the basic foundation of the concepts. Now, all projects have risks. This is really, really, really important slide. So whatever you see out there, the bright and shiny objects, whatever the promoter, the sponsor, the operator, the fund manager is telling you, be very careful and always realize that there is risk in every investment. There are all kinds of risks, and I'm going to focus on the construction risk and related issues to COVID. But it's one of the most important risks is construction risk. You are not necessarily going to get to the result. Construction could have problems, delays, and so on. But this slide is all about various risks. So we'll talk about COVID-specific risks, one of them being construction risk. There are all kinds of other risks: government regulation risk, zoning, occupancy risk, insufficient capital, environmental risks, local conditions, shortage of capital, projections could not be met by actual results, key man risk, natural disaster, and so on and so forth. Just realize that investment grade projects, they have risks too. They're not risk-free. Just the risk is higher for speculative projects versus the investment grade. And there are no guarantees at all. So how to compute typically a risk-adjusted return? You adjust for the risk. You take the projected return and you have to subtract risk loss reserves. And it's not easy to compute those reserves, but that's mathematically how it works. Your risk-adjusted return is your projected return minus risk loss reserves or allocation for risk. Now let's talk about COVID-specific created risks. One of them is cost-driven inflation. And these risks are driving the adjustment in investment strategy today. So number one, we're all aware of massive supply chain issues. And we're recording this February 1st, 2022. We're still struggling with supply chain issues, and every projection I hear, these issues are not going away anytime soon. It's probably going to take a couple of years to get to the pre-COVID level of the supply chain. So in the meanwhile, disruptions are still there. As the world reopens after Omicron risk, there might be another variant of COVID. Meanwhile, the reopening is taking place as the variants are becoming milder and milder, causing less and less risk of death and other serious complications. The consequence is more and more countries need the materials, they need the supply chain, and the production takes a long time to start. So supply chain is not going to go away very quickly. Next, it is very hard to predict project costs. The cost escalation has been rapid, and it's been unpredictable, very volatile, and many operators struggle to project costs accurately. This is going to continue. You may start the project today and wind up with one budget in the pro forma projections. By the time you're done with the project, the cost could overrun substantially. I've heard stories, horror stories today. You start with a budget of, say, $10 million, you wind up spending $15, $20 million on a project, almost double, 50% higher. These costs are escalating at such a rapid pace, it's difficult to project. Project delays. One of the big issues is driven by partially by the supply chain, partially by shortage of folks who are needed for the projects. Inspectors don't want to go to inspect. Hard to find the labor to do the work. Hard to find materials that you need. There's all kinds of complexities related to the construction. And the project delays do take place as a result, substantial delays. And the delays add to the cost of the project, as it takes, a lot of the projects are leveraged, they have debt service, and if it takes longer to complete the property, there's a massive additional cost of capital, the debt service that need to be kept. So that's a substantial risk. Another major risk is speculative future value. The good news has been that we've seen cost-driven inflation, higher reconstruction cost. When the product is completed, typically the prices have been going up. It doesn't mean that they will be higher in the future. It's speculative. The fact that people are paying higher prices today doesn't mean they will be paying higher prices tomorrow. There may be some market adjustment, and the future value may not be where you project or the project sponsor projects. So the degree of speculation has increased as a result of COVID. Uncertainty is higher, volatility is higher. So here is an adjustment strategy. And again, most of the projects we're talking about here fall into quadrant, some 2, but mostly 4. So quadrant 4 deals are your typical development, redevelopment, some other speculation. Why is this important for quadrant 4? Because a lot of deals fall into quadrant 4 today. And we're dealing with very substantial amount of investments in quadrant 4 deals. And there are deals in quadrant 4. Let me just jump back to the quadrant methodology. So the quadrant 4 deals could have high return targets. But the issue is that there's a lot of risk. Some projects have very high level of risk, specifically construction-related risks, and some have lower degree of risk. And then what we're trying to do, we're trying to adjust, lowering the level of risk. Again, there are great investments that fall into quadrant 1, 2, and 3. But today, we just focused on quadrant 4 because the amount of capital flowing into these type of projects today is very, very high. And a lot of investments, including our family of funds. We love generally quadrant 2 deals for growth projects. Some of these projects fall into quadrant 4. So it is important, and some are borderline, just to be very clear. So the borderline projects, quadrant 4 with quadrant 2 is what we're looking for. The projects with lower degree of risk that are still probably quadrant 4, but they're closer to quadrant 2. They carry a little bit more managed risk. And then obviously quadrant 2 deals where there's value add work, but it doesn't turn the projects into negative cash flow. As a result, they're not as speculative in nature. And we love those type of projects, specifically value add multifamily, where the project at least breaks even at the beginning. Ideally, cash flows a little bit, but it's not a requirement. So let me jump back to the adjustments for the COVID strategy. So adjustments is reduce investments in ground up or heavy value add projects. We do this in our family of funds, in Temple Growth Fund and Temple Growth Fund 2. We're taking less risk now. We like more certainty and lower level of speculation through the deals that have less construction related risk, as that risk is very difficult to quantify, especially during this very volatile COVID created supply chain cost inflation world. And we increase investments in the conversions of hotel to multifamily, value add multifamily projects. Why? Because we would like to find projects that are easier, more predictable, have incremental construction of value add work or redevelopment versus ground up. Conversions don't need the structures to be redeveloped. They're already there. So the costs and the complexity is substantially lower. And as a result, it reduces risk. So again, hotel to multifamily conversions take typically 12 to 18 months from the start of work to a full stabilization. Compare that to ground ups, which typically could take anywhere from 2 to 3 years. So the path to full stabilization is a lot shorter. It's a lot lower risk. And then we like value add multifamily that benefit from inflation-driven rent increases without heavy construction. Now, we still want to see renovation of units. We still want to see improvements of the property. But what we don't want to see is a lot of risk associated with heavy construction. So as long as the area is supporting higher rents, cosmetic renovations could improve the values, and it becomes easier to increase rents without massive capital improvements on these type of projects. That's it. Appreciate your time and attention. This was intended to be a short video. Stay tuned for future short updates. Thank you again.